Hi everyone, welcome to today's webinar. My name is Fawad Razakzada, market analyst with Think Markets. So for those of you who have joined us live, please make sure you ask us questions in the chat box or in the questions box, or you could wait until the end of the webinar. It's up to you. But for those of you who are watching a recording of this, please make sure to join us live next time so that you have the opportunity to ask us questions during this this webinar. Now, this webinar is obviously a preview for the upcoming jobs report, which will be published later on today. And it's divided into two parts. First, we will discuss some pre-NFP leading indicators to try and come up with a rough idea of how the headline jobs number may look like, and how this will impact, or how this might impact, I should say, the markets. The second part will all be about technical analysis of a few major currency pairs, gold and indices, in order to provide some actionable trade ideas after the jobs report is published. So before we do that, please have a look at the risk warning and the disclaimer. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So I already mentioned the agenda for today's webinar, but yeah, just a quick reminder that it happens every first Friday of the month when the jobs report is published. So make sure you join us for the next one. Yeah, the rest I've mentioned. So let's move on and discuss why the non-farm payrolls report is so important. Well, it has traditionally been one of the most eagerly anticipated macro events for the markets. This is because the Fed has two mandates really, which is to maximize employment, and the other one is to keep inflation around the 2% expected target. Over the last couple of months, the focus has returned to jobs and inflation as the US and global economies recover from the pandemic. Now, how long will the Fed keep its emergency stimulus measures in place is the key question, and the jobs report has a big say in it. The Fed thinks that inflation is going to be temporary, and it will want to see further big gains in jobs before it starts to withdraw monetary support. Since last month, the dollar has been pushing higher, along with the stock markets, as the Fed has become comparatively less dovish than other major central banks. Judging by the dollar's outsized gains so far this week, it looks like the market is now positioned for a stronger than expected non-farm payrolls report than what the economists are expecting. But will the jobs report disappoint once again? I remember the last 2 months, we've seen weaker than expected numbers on the headline front, whereas the wages have beaten expectations. Okay, so after those two below forecast readings, economists are, well, they're optimistic that we will see an improvement from last month's 559,000 print on the headline front. So they expect the latest employment report to show 725,000 net new jobs for the month of June. So that's the key number, 725. The unemployment rate is seen falling to 5.6% from 5.8%. In terms of average hourly earnings, well, this is expected to have climbed by about 9.3% on the month, which would be a touch weaker than last month's impressive 0.5% rise. So while the headline jobs data will be important as always, I think the market will be paying equal attention to the wages aspect of this report, because inflation has risen sharply of late. We've already seen above forecast reading for wage growth in each of the previous two jobs reports, as I mentioned. with average hourly earnings rising by 0.7% in April and 0.5% in May. So another above forecast reading could encourage the Fed to taper QE sooner than expected, especially if jobs growth also accelerates. Okay. Now, in terms of the four kind of leading indicators that we usually use to determine how strong or otherwise the NFP might be, well, the ISM services PMI will not be out until next week, which means we won't have the employment component of the services, the dominant services sector to guide us on this occasion. So we have fewer data points to work with in trying to come up with a forecast for the headline jobs growth. The other indicators provide a mixed. They provide mixed readings. Really, the ISM manufacturing PMI, which came out earlier this week, it edged lower to below the 50 boom bust level. It printed 49.9, down 1 point from the previous month, which is not a great sign, to be honest. The ADP employment report, which usually comes out on a Wednesday, this has been a poor leading indicator for the NFP. Still, it showed 692,000 jobs, which was well above expectations, but down from the previous month's downwardly revised 886,000. So it's kind of a mixed to neutral reading insofar as the ADP is concerned. The average hourly earnings, the 4-week moving average of initial claims, well, they fell to 393,000, which was an improvement from 428K the previous month. So obviously we want a lower number for unemployment claims. This aspect of the report was positive. But overall, the above indicators, they point to a slightly weaker jobs report, I think, with the headline likely to miss the expected 725,000 jobs. However, with the ISM services PMI not being published this week, this particular employment report is even more difficult to predict, which means that there is a wider scope for a surprise. But yeah, as I keep mentioning, whatever the headline jobs data may be, don't forget to take into account the average hourly earnings figure to gauge the health of the labor market and, more to the point, deciding on a trade, which reminds me to talk about trade ideas. I haven't updated this particular slide from the previous webinar because it still remains valid. So the trend for the dollar was positive in June after the FOMC's hawkish dot plots made the Fed appear less dovish than other central banks. That's why stock markets didn't fall, but the US dollar rose. Sorry. We've heard from a couple of Fed speakers. They've become a little bit more vocal in terms of tapering QE as well. So the dollar has risen, and it's all because the Fed has become relatively less dovish than other major banks. Stock market investors know full well that it will still be a couple of months at the very least until the Fed starts reducing the pace of its asset purchases program. Even then, the US and other global central bank policy would still be quite loose. So today's jobs report is not going to change. It's not going to be very important in the grand scheme of things because it's only 1 month worth of data. But we have seen improvement in US data and rise in inflation. So if we get a really strong set of figures today, that could provide the dollar a further boost. So today's report can cause at least some short-term volatility. And so in terms of what might happen, well, if we see a strong set of results, such as, let's say, 800,000 on the headline front and a 0.5% rise in wage growth, This should keep the dollar bulls happy. The dollar yen would be the obvious choice for me, because yen is really weak, and the dollar obviously has strengthened because of expectations that the Fed will be the first out of the two major central banks to tighten its belt, right? So the dollar yen could very well break further higher. Watch out for the dollar Swiss as well in that scenario. Perhaps looking at shorting gold, although I don't really like shorting gold too much, because it's not just the dollar that's impacting gold prices. It is one of the major drivers, but it's not the only thing. Gold is more responsive to yields, so I would be less inclined to short gold, even if the US jobs report comes out really strong. I'd be more inclined to go long on the dollar against a currency pair like the Japanese yen or Swiss franc, rather than short gold. Okay, so bear that in mind. If we see the data come out around the expected figures, this would likely be slightly negative for the dollar. So we could see, for example, the likes of commodity dollars like the Canadian, the Aussie, the Kiwi dollars outperform, because stocks will likely respond more positively to an inline jobs report, because it will keep the Goldilocks scenario intact. Both the economy is improving, but not so much so to raise inflationary concerns. So if stock markets go up with a expected jobs report, this should provide some support for the commodity dollars. So maybe looking at the Aussie yen could be on the long side, or Kiwi yen, or even the Aussie dollar, who knows, against the US dollar could go up. Now, the alternative scenario is if the non-farm payrolls disappoint really bad. Okay, so if we have a really poor set of numbers today, then I would favor looking at shorting the dollar against some of the other stronger currencies out there. And I know the euro is not a very strong currency at the moment because of the dovish ECB, but the Eurozone economy has started to grow more rapidly in recent months because of the pace of vaccinations programs and stuff like that picking up. The pound obviously is really strong as well. I think obviously it's weakened against the dollar last month, along with all the other major currencies. But with the UK being well ahead in terms of its race against, in terms of its vaccinations race, then I reckon the pound is going to outperform in the long term, because the UK economy is likely to rebound strongly. So if the jobs report is really poor, I would look for long pound against the dollar. And I would also entertain the idea of going long gold if the jobs report disappoints. So those are the three kind of scenarios we're looking at. Now then, let's exit this and start looking at some live charts. And I can see a question from HH Hassan. Please keep your questions coming. How do you define support resistance for each TF you may use? What is TF, Hassan? Time frame, you mean? Okay, I think you mean time frame. Okay, so how do I define a short-term support and resistance for each time frame I use? Okay, so the way I look at support and resistance is really simple. Here, for example, we are looking at the monthly chart of the dollar index. I want to show you the monthly chart because to highlight how the dollar has outperformed in the last month, but that it still remains within its wide consolidation range between around 93 to around 90-ish. So it's a 300 pip range, which it hasn't moved out of yet. It may well do, but it hasn't moved out of that range yet. To answer your question, Hassan, the way I look at support and resistance is I look at previous areas of trouble. For example, in this zone here, the dollar index had previously found had a struggle to bounce, right? So when this area broke down and price went below it, then when the market was coming up to retest this area, I was expecting the dollar to go down from there, which it did. Yeah, because previously people were buying here, but that buying failed as the dollar index broke. So naturally, people who were looking to go long would be now looking to sell based on the fact that in the past buying didn't materialize there. So that's the most basic way I look at support and resistance. This time, however, because this area has already been tested as the dollar index counts, it's still possible that the dollar may go down from here, but it is less likely than the initial test. Okay. I also look at trend lines and other technical factors when looking for resistance or support. And this is regardless of the time frame you use. It's relevant on all time frames. So this is the monthly, but this can easily be the daily or the weekly chart, or even the hourly chart. Okay, so when looking at price action from when looking for support and resistance using price action, the time frame is not relevant. It works on all time frames. So, for example, another way of looking for support and resistance is using trend lines. This trend line had been established once we broke below it. When the dollar index tested the trend from underneath, I was expecting it to go down. Why? Because previously people were buying on the test of the trend line. Simple as that, really. I hope that answers your question. There's lots of other ways as well. For example, one way I look at resistance is when the market fails to do what it should be doing. That's one of my favorite ways. What do I mean by that? If you look at here, for example, we had resistance here. The market broke above it. Sorry, I'm taking my time to answer this question because I think it's a really good question. The market broke above this area of resistance, right? So when it was coming back down, what should have happened was for the dollar to bounce from there and go up, right? This is what it should have happened. Instead, what actually happened is the dollar broke down, right? It broke down rather than bounce from that resistance, from that previous resistance area. So when it breaks down, despite price making higher highs and higher lows, with the 21-day exponential being rising and so on, this is one of the best ways, in my view, to look for trades in the opposite direction, because this disappointed people who were looking to go long. Where would their stops be risking? Well, below this low and below this low, right? And what happened is the dollar, because it failed to go up, people started selling on the next few sessions, and it started to head lower, eventually taking out liquidity below this low, and then over time going all the way here to take out liquidity below this. It fell, it didn't quite take out this low, which I was expecting, the low that was hit in January. The dollar could still come back at some later point in time to take out that low. Who knows? But it needs to show a reversal sign first. Right now, it's looking bullish, but it's approaching or testing resistance, right? So it could very well turn around from around current levels. But what I'm looking for in particular, insofar as the dollar index is concerned, is for this area of support. The mouse is not working properly today. So you see this area. This was the last down move prior to the index breaking higher. So if we go below this area in the coming days, so instead of price bouncing back from here, if it breaks below this low, then that would be a key reversal sign for me, because of it's going to be very similar to what had happened in here. So in that case, I'll be then looking to short the dollar on retest to take us possibly all the way down to this low here before it has a chance to bounce back. But insofar as today is concerned, obviously this that's something that might happen. Who knows? It's dependent on a lot of things. Insofar as today is concerned, we need to look at short-term levels, right? Because we're only talking about one session here for the purpose of this webinar. And the key support on the dollar index to hold is this level right here at 92.40. That level was previously resistance. We broke above it yesterday. And so what we may see is the dollar might fall initially on the back of a slightly disappointing report before potentially bouncing back. So that could be a tradable bounce. Yeah. In terms of resistance, this right here is where the market kind of broke down from previously. What are we looking at? Sorry, guys, give me 1 second. I just got a notification on my phone. Yeah, so in terms of resistance, I'm looking at 92.87-ish, 85 area, because that was the base of the previous breakdown. We might find some resistance around that area, particularly because we have a bearish trend line converging as well. See that? So that's an area where the dollar may struggle today if we get there. Now let's look at a few major currency pairs. Okay, so the dollar yen is the obviously is the obvious choice for people who are looking at going long the dollar, and the key level really is this at 110.95, 96, which was previously resistance. We broke away from it, so that level remains exposed for a potential retest. Just to give you a bit of a range rather than a specific level, the high of this candle and the high from Wednesday's range come in at 111.11. So it's the area between these two levels at 111.11, 110.95, the shaded green area, which is the key level to watch for a potential bounce from here. Okay, so if the dollar yen gets here, we may see a bounce. The key invalidation level for me is this level here, which was the last low made this week prior to the dollar yen breaking higher. That's if price were to return to below this area, this would be this would create our first lower low, right? So that's the invalidation level for me, the line in the sand. I don't want the dollar to go below this low here, right at 110.42. Okay, in terms of resistance or potential target, we have the 127.2 extension of the Samsung coming in at 111.92. The 2020 high is at 112.22. So those are your key levels to watch on the upside, especially the latter, the 112.22 level, which was the high from last year. Very important resistance this is. Okay, that's the dollar yen. Now, if you're looking to short the dollar rather than going long, so in this case, we are looking to go long in this shaded green area in the event the dollar, the jobs report doesn't disappoint too badly. But if the jobs report disappoints badly, I mentioned gold, didn't I? Let's quickly look at gold, and then we will come back to the currency markets. This is it. Gold is looking really interesting today because, on the one hand, price making lower lows and lower highs and whatnot. On the other hand, it's creating a right shoulder, or potentially creating a right shoulder of this inverse head and shoulders pattern. So let me just quickly show you yields chart. And Okay, let's go back. It's not loading for some reason. Yields have not really gone up much in the last couple of weeks. This has allowed gold to build a base here. So let's zoom in this area. What's happening? Is it creating the right shoulder, or is it a pause before the next drop? That was the key question I asked in my previous webinar. Well, those questions could be answered later today. Let's zoom in. So what's happened here is, let me just clear a few things. Price testing the 61.8 Fibonacci retrace against the move up from March, right? 61.8 is really important for gold. If you don't believe me, just draw your Fibonacci's from previous swings. So if you, for example, use this upswing, hold on. See from this low in March when gold went on to hit a record high. If I draw the Fibonacci from this low to this high, look where it formed the head of that inverse the shoulders, right at the 61.8. Similarly, if you, I'm not gonna waste your time too much. If you draw from here to this low, about 78.6 on this occasion provided resistance. So it's the area between 61.8 to 78.6 that gold usually finds support from, but mostly the 61.8. In any case, in here, gold has it broke below this low after a big drop. It consolidated for a while. Tried to break below this low. It failed. Look at the closing prices of these daily candles. Gold held its own above this low, possibly suggesting that it's trying to form a base here and create the right shoulder. Okay, so what I'm looking for next is how gold prices will close today's session. Excuse me. Now, in terms of the key level that needs to break, I think is this high here. This was the last higher high made prior to gold breaking down. So the specific level is 1797, the level that needs to be taken out for gold to turn bullish. In terms of support, I think yesterday's high at 1783 is going to be very important. So that could provide us some support if the metal eases back down a little bit from its highs. But ideally, what I'd like to see is a higher high now above this resistance area that has capped the gains for gold in recent times. See the wicks of these candles hasn't gone above it. So what I'd like to see is a move north of this area, and then any rounded retest of that zone could be a buy the dip opportunity to take us possibly all the way to 1850, which is the next area of resistance on the daily chart of gold. And I wouldn't be surprised if that area converges with the 61.8 February trace. Boom, right there. So that is the next key resistance zone. I'm not saying we'll get there today, okay? But if the jobs report disappoints expectations really badly, then this is the scenario I'd like to play. I'd like for gold to play out. Let's have a look at the questions box. I can see another question. From our NFP trade ideas, dollar seems to be strong, right? That's very correct. Yeah, the dollar is strong across the board. However, it's not so strong against the precious metals over the last few days. Gold in particular looking quite strong since turning around on Wednesday. Silver is, would you believe it, testing the respecting the 61.8 retrace, yeah, and finding support from the 200-day moving average. Silver is also not above. It's not out of out of the woods just yet. 26.50 is the high created prior to the price of silver breaking lower, and that level needs to break for the technical bias to turn bullish or positive once again. So we're looking for a move north of 26.50 or 49 for silver. But I like the fact that it's kind of trying to build a base here. However, on the long side, we do need to see that breakout. Happy Friday, definitely. I'm in the middle of a webinar. Sorry, guys, let me just close this. Okay, so gold and silver are covered. Let's have a look at, let's go back to currencies because we didn't look at, the pound. Okay, so the pound is looking weak along with all the other dollar pairs in recent times. And in my previous webinar, I said it might do something like this. It might break down temporarily, but what I'm looking for is an immediate rally back above the blue level, which was the recent low. So I want the pound to go back above 137.87 to form a potential, to signal that it has potentially formed a low. Because unlike the other major currency pairs, the pound is still within its, albeit it's in the lower end of its recent range, it's still within its recent range. Okay, so it hasn't really broken down, which suggests that it's relatively stronger compared to some of the other weaker currencies, especially the yen. Insofar as today is concerned, the key level is 137.87, which was the previous low. If we move above that level on a daily closing basis, that would be bullish. While we hold below that level, then there's a risk we may see further weakness in the short term. And the key level of support that I will be looking at is the 2022 high, last year's high, that was formed literally on the last day of the year at 136.86. So around that level is where I'm expecting, if price were to get there, that the pound might find a base, because we also have the 200-day moving average coming into play right there as well. Now, when the 200-day moving average is rising, as it is in the case of the pound, this is a strong indication that the long-term trend is bullish, right? It's a objective way of telling the trend. So in the short term, you will see price breaking down and moving sideways, like we did, for example, here. And we're seeing again weakness. It doesn't mean that the long-term trend has ended. It could just be a pause before a big move up in the coming weeks. But for now, and so far as the short term is concerned, the technical bias is bearish because price is making lower lows and lower highs. So you wouldn't want to fight that trend until price creates a bullish reversal signal. Emmanuel, from my technical analysis, on gold, the dollar also looks strong. It was looking strong on gold, not so much this week, because gold has potentially created a low here. It needs to go up a bit more to confirm, but this false break below the prior low and holding its own around the 61.8 suggests that it may have formed a low here, yet to be confirmed though. So to answer your question, no. Dollar only looks strong against the yen and a few other currency pairs. Not so much against gold. It did look strong against gold previously when the Fed turned hawkish or less dovish and gold slumped, but it has stopped going down for now anyway. And guys, let's just look at a few indices as well. I know there's people in this room that trade indices. Obviously, the FTSE is not going to be as important to watch as the US indices because of the US jobs report, obviously. But it is on the verge of a potential breakout as it tests this key resistance area right here in the shaded region. So keep an eye on the FTSE as I show you the weekly chart. On the weekly, last week it formed a green candle or a white candle in this case, after refusing to break down. In the previous week, it had formed this bearish candle, right? Last week, it tried to break below that candle's low. It didn't follow through, and instead it crept higher. So that was the key support level at near 7,000, which held this week as well. And now we are near the upper end of that resistance range. So if you look at from a technical aspect point of view, the fact that it's trying to break through this resistance on several occasions without going down too significantly, and the recent drops from this resistance zone has been progressively shallower. This is a strong indication that the index wants to break higher. Now the FTSE has what do you call it, underperformed other global indices, so it may be time for the FTSE to start playing catch up with the other major indices and head higher from here. So watch out for that potential scenario. Now let's look at US indices, starting with the S&P 500. S&P is at all-time highs. Yeah, there's no point in trying to look for shorting, looking for short trades in a rising market like this. You should be concentrating on buying the dip, yeah, because that's the trend. So in terms of today's session, obviously with the index going up for several days in a row, there is the possibility of a short-term correction is increasing each day, but the markets can remain overbought for a long time, as we saw in this period here when the S&P 500 kept rising for several days. So looking for a trade in a market like this on the long side is going to be tricky. You really have to zoom into your short-term timeframes to look for levels. And just to highlight a few levels, yesterday's high is important. This breakout area is important. So support at 4,303 is going to be important, because that's the base of the breakout that happened yesterday. We don't want the index to go below that level if we're bullish. If it goes below and holds below, then there's a risk we may see a return towards the trend line or this support here at 4,244. Where's the Nasdaq? Yeah, like the S&P, Nasdaq is also at record levels. It broke out from this trend line several days ago, and it hasn't really looked back. This market looks really strong. I again wouldn't advise looking for bearish setups until we see a clear reversal pattern in the markets. So any short-term weakness you see should be viewed from a bullish point of view. Anyway, we have run out of time. I can't see any further questions. So just going back to the slides and to remind you that the jobs report will be published soon at 1:30 London time. Expectations center around 725,000 for the headline jobs growth. And the unemployment rate is seen at 5.6%, with average hourly earnings expected to rise 0.3% month on month. Okay, so those are the key numbers to watch out for. Thank you so much for joining me. It has been a pleasure. Please make sure to join me for my regular webinars. If you go to our website, we have weekly webinars. So if you like how we analyze the markets from a technical analysis point of view, we please make sure to join us on Tuesdays at 11:30 London time for our live webinars. So if you go to the website, thinkmarkets.com, click on live webinars, here you will see a list of upcoming live sessions, and you can click on the register button to register for those webinars. Anyway, take care, and I will speak to you guys soon. Thank you. Bye-bye.